Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Financial Markets Authority CEO Rob Everett. Thanks for coming in, Rob. Good to see you.
My pleasure.
We're going to have a chat about three things. We could sit and talk to Rob all day, but we don't want to take up all his time and go into too much detail on everything, but we thought we'd have a look at KiwiSaver, peer-to-peer lending, and the Financial Service Providers Register. So if we kick off, Rob, with KiwiSaver, we've got over $30 billion of funds under management now. We've got the big six providers, I think, accounting for about 86% of that. One of the interesting things that I've been watching is, I guess, as it grows and as the key providers who are primarily banks grow, they get economies of scale, obviously, out of managing so much money. What can the FMA do to help ensure that those economies of scale the providers get is passed on to consumers?
Yeah, it's a good question, and as you know, KiwiSaver has been a huge focus for us, largely on the broad spread of New Zealanders that it touches. Same way managed funds as a whole is a big issue for us. So that whole issue about how are customers being treated and how are the providers basically treating their privileged position as KiwiSaver providers to make sure that happens, is huge for us. We spent a lot of time, as you know, looking at switching. We have a lot of time looking at disclosures, a lot of time looking at fees, and just generally spending time with the providers. So we are confident now that some of the messages we were delivering last year and before that have been heard, and that the processes the banks and other providers follow in trying to engage with their customers, including switching conversations, are better handled than they seemed to be at the beginning.
Yeah, I mean, obviously the banks, they do have an advantage over other providers, the QFE status and just the scale, the retail networks they have, and it's a great area for them to really push into and try and cross-sell to, I guess. So you're comfortable around the conduct of the banks at the moment and their sort of broad behaviour in KiwiSaver? Yeah,
so as you know, we did do a lot of work, not just with the banks, on switching processes. You're actually absolutely right. KiwiSaver for some of the providers is an entry point into a broader conversation. So what we've been trying to do is make sure that any conversation that does involve switching is handled properly, and we're confident that the influence we're having has been beneficial there. We're also very focused on getting KiwiSaver providers to take seriously the obligation to engage with their customers. So that's not necessarily about switching, it's about contributions, it's about are you in the right fund, it's about how have you really built this into your financial planning. And so we're spending actually at the moment more time really trying to make sure providers take that obligation really seriously and helping them understand when that's an appropriate conversation and when it might veer towards trying to encourage someone to do something that they can't demonstrate is in their best interests.
Now, Treasury did a big report on KiwiSaver last year, which I'm sure you will have seen, and they described the fees as opaque. Now, the FMA put out an information sheet on performance-based fees just the other day, this week. It's a fascinating area and obviously a very important one. Just wondering, I mean, there seems to be a lot of opportunity for divergence in fees and how fees are described. Is the FMA not able to be stricter in terms of your guidance or expectations around the fees that are charged?
It's a difficult balance, and if you look in other jurisdictions with big managed fund industries, the same challenge exists. We have to get a balance between allowing a variety of different business models and ways of doing things, with the need for investors who are often not professional investors having a good chance of being able to do some research and work out what the performance of their fund looks like versus someone else. So that balance in trying to narrow it down to comparable data and comparable disclosures, against the fact that when you do that, you end up shoehorning sometimes stuff that could be just slightly different because of the nature of that fund or the nature of the manager's mandate, and therefore losing that ability to be flexible. So we, like most regulators, are of the view that the industry hasn't done enough, and that the fees and the performance benchmarks and the risk indicators and all of those things could be explained better, and they can be explained in a way which is a bit more comparable. The actual level of the fees is not something that we have jurisdiction over. And obviously the legislation here actually sets out a whole bunch of things that need to be in disclosures that we don't get to change. But all in all, what we're focused on is making sure the fund managers, and particularly KiwiSaver providers, but everybody, is properly focused on, am I providing this in a format and in a way that someone might actually read it, and if they do read it, does it tell them pretty much everything they need to know? And it's a difficult process. I think probably we've only just really started moving that needle on the dial, but it's so critical to the success of this sector.
You mentioned in terms of the level of the fees, the FMA doesn't have jurisdiction over them. Is that more of an area for the Commerce Commission?
Well, it would be, I think, if they felt that the sector had become uncompetitive in the way that the interests of the customers were being harmed. And certainly there is a lot of focus on fee levels. But you made the point earlier, KiwiSaver may be up to 30 billion, but in global terms, that's a drop in the ocean in terms of fund management sectors. If you look at the US, for instance, so
even Australia,
even Australia, and actually some of the fees are quite comparable to Australia already. So, whilst I would never say I don't think the fees could come down, it is a byproduct of sheer scale, and I'm just not sure we're quite at that scale yet.
Okay. Look, we'll move on to peer-to-peer lending. Now, obviously, the FMA runs the licensing process there. There are 4 licensed peer-to-peer lenders up and running now. Just wondering if you're seeing more in the pipeline that could be coming along, and I guess what your feeling is over the size of that industry thus far.
Yeah, the really interesting thing about peer-to-peer for us, and you mentioned this in your intro, is that the sheer variety of business models that are existing, and the legislation was set up to allow that to happen. It obviously makes it a challenge for us to license what are effectively every time a new business model so far. And they're targeted at different customer segments. They've got different types of secured or non-secured, different types of fee structures. So it is a bit of a challenge, but the legislation was designed to encourage that. So actually we think that's a good thing, that there'll be lots of business models. We don't think any of them really have had long enough to operate yet to be clear on what will work and what won't. Harmony got off to a flyer, obviously, but they have a particular business model actually which might not be replicated by a lot of the others. So hard to know how much traction it's really going to get. And as I think I've always said, once we've been through a down cycle and the credit scoring models have come into question, we'll have a much better sense of what the sustainable level of retail involvement is in peer-to-peer lending as opposed to small business involvement.
Yeah, you mentioned the fee models. Obviously the Commerce Commission is having a look at whether the fees charged by peer-to-peer lenders are covered or should be covered by the fees provisions in the Credit Contracts and Consumer Finance Act, the CCCFA as most people know it. Obviously against that backdrop, Harmony went and changed their fees, so they obviously thought they needed to or decided it was a good idea to do so. I'm just wondering, it's early days, it's a new industry, but was the fee issue adequately looked at, I guess, in the early days? I mean, I guess between yourselves and the Commerce Commission, it seems quite early for something that significant to crop up.
Yeah, again, so our mandate really is to make sure that the fees that are being charged are properly disclosed and that they're easy to understand, and that is what a lot of the debate we have with the new business models is around the fee structure and not so much what the level of the fees are, but really does that make sense to someone? Can they really understand it? So that's got a lot of attention. And obviously all of the peer-to-peer lending platforms are going to have to work out with their advisors how they fit against the CCCFA. Some are designing models that are more clearly outside, and some are designing models where they've acknowledged their inside. So I think that's always going to be a tension that's kind of built into any sort of lending model. But our focus really has been on, if you were investing money in one of these platforms or through one of these platforms, are you able to understand what you're being charged for and what you're not being charged for?
Obviously, it's still early days. Aside from Harmony, the other 3 that are operating have only been doing so for a few months. But Harmony's been around for 15 months or so. They've facilitated $200 million of lending, and they're rattling along at quite a rate, which was always their plan, and they were very open about. What's your feeling in terms of how fast the industry is growing and where it could go, within a couple of years? Yeah,
Harmony do seem to have done a lot very quickly. And some of the tensions you refer to probably reflect how quickly they wanted to get into that market. I guess the area that I'd really like to see grow is that notion of peer-to-peer lending filling a gap in the capital raising spectrum for smaller businesses. And some of the new models are more focused into that space. So I think you're always going to see some peer-to-peer lending in the true individual lending to individuals. But we're obviously under the FMC Act quite focused on capital raising and helping methods of raising capital for smaller companies become sustainable and exist. So I'm quite interested really to see where some of those models go and whether it does actually fill a perceived gap in New Zealand of a lack of investment at that level.
That will be interesting to see. Now, I guess another issue that crops up, especially if you talk to people, I guess banks, not so much yet, but maybe consumer finance companies, they look at the way the peer-to-peer sector is regulated, and it's a lot lighter, obviously, than how they're regulated. Just wondering, if and when you think the peer-to-peer sector may need stricter regulation, and what would be key factors in deciding whether it did? Yeah,
it's a good question. I mean, both for crowdfunding and peer-to-peer lending, as you know, there were initial limits set on how much companies can raise through that. I think with that very much in mind, which is as a test ground develops, you want to make sure that at least in some way you've put an overall cap on how much people can lose in particular instances. So I think that was pretty sensible. Again, it's too hard really to tell at this point. I think it's too early in the phase, and I would think, based on conversations with MB, they've always had in mind doing a review of some of those features, but probably not for another year, maybe 2 years. And again, without having gone through a distinct change in the credit cycle and the interest rate cycle, it is a little bit hard to see how those models will perform. So I personally would be reluctant to do a review like that until you've been through that. So there is, of course, a school of thought that says that if it's been going okay so far, that actually we should take some of those limits off, but I don't think that's going to happen either at this point.